Okay. I guess we'll go ahead and get started with the panel. Thanks, everybody, for coming. We have just a short half hour or so to talk about a pretty important topic, which is how we can all help one another in situations where it's mutually beneficial. So it takes a village to do lots of things, and it sometimes takes a village to have a successful investment. And so we have a great panel assembled here today with backgrounds that you'll hear about from each of them in a moment. I'm Mike Ryan, for those of whom I have not met. I have a family office, MDR Capital, and spent the majority of my professional career at Goldman Sachs, and then worked at managing money for Harvard University, and then have been investing my own family office capital. And as you may have heard in an earlier presentation, we make our analyst team and our technology available to other family offices in pursuit of direct investments. I'm going to ask each of the panelists to introduce themselves in a little bit longer than I did, but about that time, maybe a minute or two, so you can get a flavor for their experience, and then we'll get right into the topic of how single-family offices are pooling resources for mutual gain.
Hi, I'm Teresa Esser. I live in Milwaukee, Wisconsin. My angel investment network is called Silicon Pastures Angel Investment Network. My husband and I went to MIT. He started an Ethernet telephone company that raised money from the MIT endowment directly. He raised venture capital. I wondered how he did it, and so I decided to research and write a book on how venture capitalists make decisions. If anybody would like a copy of that book, come and give me your business card. I give away copies. It was published by Time Warner. It turned into a foundation, the Venture Cafe, and there are networking events that they put on in 8 cities around the world, including Rotterdam, Miami, so you can get a free beer out of this foundation paid for by venture capitalists. So I make investments in the Midwest Great Lakes region, and I add value to my portfolio companies. Midwesterners are often insular. We work really hard. We work on manufacturing. We manufacture things, and we sell them. We export. The Midwest has a trade surplus. We have a trade surplus, and we export out of this country. And I want to do more of that. I want the United States to manufacture more and sell more and export more. And I use big data. I use big data to figure out how we should do that better. So I'm on a mission, and my mission is to help the United States export more.
Thank you, Teresa.
Thank you. I'm Vincent Pica. I'm one of the managing partners of Safanad. I see some familiar faces here. I know Richard's probably outside doing his own networking, but thank him for inviting me back. I worked on the street as well for 25 years for a company called E.F. Hutton & Company, and then Prudential Securities. Left in 2000 to start what eventually became Safanad. We own or control about $10 billion of real estate or private companies now in a small handful of what we call verticals. And we are the largest investor in everything we do. We're really an old-fashioned merchant bank. We started with family office backing, so to speak, but our intention always was to be a merchant bank, an asset accumulator, and to do that in partnership with other like-minded institutions from the region, from the United States, and from the Far East.
Thank you. Angela?
Hi, my name is Angela Lee. These days I wear 2 hats. I spend most of my time at Columbia Business School. I'm the Chief Innovation Officer there, and I teach courses in leadership and venture. And then I'm also the founder of 37 Angels. We're an angel network based here in New York, comprised of high net worth individuals and family offices, and we invest primarily in seed and Series A tech-enabled startups. And we also teach people how to be investors. How do you figure out valuation? How do you invest in the next unicorn that we all so desperately want to be in? And prior to this, I'm a recovering management consultant, and I'm a former founder. 37 Angels is my 4th startup.
That's great. It's a rush to judgment here. So we are a 300-member investor group, Landmark Angels and Landmark Family Office. So the difference is we have high net worth, and then we have ultra high net worth in the family office sector. And we put together an investment alliance of some of the top families in the U.S., essentially to, what we're talking about here, co-invest together. We're not a fund yet, although we're raising our first fund, which I'll get to later. And what we do is we invest not just in venture. And the key today will be best investment opportunities. Why? So you don't lose money. That's why. And we do social impact investing in the venture space as well, and in other categories. Alternatives. The alternatives we cover are real estate, private equity M&A, and venture, with the idea that we cross-fertilize those investments into an active portfolio between stocks and bonds and these alternative classes where the returns are higher.
Great. Hello. Hi, my name's Henry. I represent Yeoman's Capital as well as YGC, which stands for Yeoman's Growth Capital, which is a later stage blockchain fund. So we're kind of the rare kind that's a family office that only invests in blockchain-related equity and tokens. And we're pretty deep in the space. My background comes from Facebook after 2.5 years of working with hyper-growth, direct-to-consumer companies, advising and growing those companies, spending over $150 million in advertising growth. And prior to that, my background is in finance, and I grew up in China and Japan. So I spent 8 years in China, 7 years in Japan. I'm native speaker in all three.
Great, thank you. So just to kick off the discussion here about collaboration and mutual gain, I'd like to ask any of you, do you source a lot of deals from other family offices? And similarly, do you share your deal flow with either a select group or a broader group of others?
Yes to both. Where our deal flow comes from, they can come directly, you said, from the family offices themselves, because we see those opportunities. But most of our deal flow will come from our own sourcing. So we go out to, as a group, to over 50 venture-type conferences a year and bring back what I call best of breed. So there are a lot of companies that compete in different spaces like healthcare, energy, and so you have to distinguish which ones are the very best. So we have to filter those particular investments that we see as potentials to bring back the very best deals. So what we've done through the family office network we have is we co-invest directly with the other families, meaning they have opportunities to see the same deals. If they're not at the events, we still show them those opportunities. There is a lead family office, and then they fill in around that lead. So we can do what we call a special purpose vehicle and put them all into one vehicle. We're fortunate that in numbers, in 2009 we had 0 family offices. Today we have, again, close to 140 family offices, not all doing venture, and that's why we're doing the other categories.
Absolutely. Just to put some numbers behind it, we look at about 2,000 deals a year, and half are completely unreferred, and half are referred from networks, of which family offices are a large part of it. Of our portfolio of 50 investments, 42 were referred in. So even though from a volume perspective we're seeing a ton of unreferred, not surprisingly, the quality is much better from folks that we know and we trust, and I believe you're only as smart as your network.
I agree. We scrub the Midwest. We know where just about all the business accelerators, research parks, angel investment networks, early stage, high-tech venture capital funds. We look through our entire region, and we have syndication relationships, so we'll call people and say, what's coming through? Is there anything that could use an Asia strategy? Do you have any products that can be exported where you're not worried about reverse engineering because there's a sustainable and competitive advantage? And so I hunt, and I don't worry about whether deals come to me because I'm going to find the right ones by just scrubbing the entire region.
So maybe we'll follow on that and ask maybe others, to Vincent to answer. What are the benefits of working with others?
Sure. Well, the obvious thing is the diversification of intellect. You know, we all have, I'm sure, suffer from the disease of I'm smart, so I'm smart in everything. It's probably not true. There's very few people that are smart in everything. So the advantages of having multiple partners, multiple insights, multiple perspectives on a particular investment opportunity or a transaction, is obvious, unto itself. Harkening back to your first question about deal flow, you're also amplifying your deal flow. I would suggest, though, that in the family office building, that culture matters an awful lot. We've had very large institutions that want to invest in us, and the culture just wouldn't be the same as what we are today, which is a partnership in every respect. So that culture, that cultural imperative runs right through everything we do. And I would suggest to you, if you're in the family office business, that sounds familiar to you.
Yeah, I think from our perspective, opportunities can come from anywhere around the world. So when we speak with other family offices, other funds, and the relationship we've built over the years, gives us a tremendous amount of opportunity for us to explore outside of the U.S. And as we all know, the return numbers from venture in Asia, in China, in Southeast Asia, and India have done much better than a lot of the U.S. deals in the past. And frankly, a lot of the U.S. VCs weren't part of that, right? So we don't want to miss that again. And part of the reason that I was hired on this in this role is allow us to open up that gateway to Asia and be more global and not just U.S. focused.
All right. So we're going to try to pick up our volume a little bit. Thank you. I know most of you have, all the panelists have great reputations and great networks with people that you get deal flow from and share deal flow with. But do you have any recommendations or thoughts about other sources, online sources, other sources, tools, places where it might benefit folks in the audience to know about if they are looking to increase their kind of access to deal flow?
Could I add something in that regard? And the 2 panels ago, someone mentioned about their architects being a great source of deal flow. So are your auditors, so are your lawyers. It's the person you go to and say, you probably have a client with just a little more capital would be a great client of your law firm or of your auditing firm. And tell us about that person. And then we get into that cultural thing with them. But they are really the gatekeepers, unknowingly so, but the gatekeepers, or at least gate advisors, of some tremendous growth opportunities. Now, we're not in the venture business, and we're very similar in one regard. You're trying to export our products. I'm trying to import our money back. So it comes from China, it comes from the Middle East. Money, every time you fuel up or buy something that ends up being made in China, I'm trying to bring that money back. So we're in the same game. But the idea of where deal flow can come from, it's not always the most obvious places, and you just have to think about who's in touch with people that need capital.
Yeah, I just wanted to add, I think that's absolutely right. Ours comes from VCs, for example, and our sponsors, Markham and other people. But I think, and you've got the online, you've got Gust, which is the angel platform, which you can see deals through Gust, AngelList, which the VCs participate in. You've probably all seen deals there if you know the venture space. The problem you've got is this. I want to raise the problem. The problem is a lot of those deals are overshopped, and a lot of those are not necessarily the best deals. Don't forget, the VCs can invest in literally hundreds of deals with a $400 or $500 million fund. You, as an individual investor, are probably going to invest in 3 to 4 deals per year. So you can't afford to make the mistakes in saying, well, that deal looks good to me, or that one looks good to me. You've got to have the best team. So what are the criteria? It's the best team you can find. Do they have strategic relationships where your exit's going to go? Before you invest $1, you should know what the possibility of that company on the exit side is. That's very important. Lastly, there are other groups that we don't have direct access to, but maybe indirect, iconic. Larry Sergey, Yates, Zuckerberg, and one of our investors, a billionaire investor, belongs to that group. Now, you have to be a billionaire. You bring your own money to there, and then they're going to see the very best deals because they are Silicon Valley deals. Well, the general public, you guys, will not see those deals, but we may be able to see them indirectly because we have that contact. We can invest through him.
All right, so that's a good start. Sourcing. Deals are coming from self-sourcing, from trusted relationships, from some of these platforms, and from accountants, lawyers, and other gatekeepers. So now you're into the process of thinking about whether to invest. So you have to do your own diligence process or your own decision-making process. Give us a sense for what you do and if and how you connect with other peer investors to collaborate on that kind of diligence and filtering and selection process. Maybe we can start with Angela.
Sure. So one thing around diligence is I think it's really important to leverage our network to get deal flow, but for us, we try really hard to still do our own diligence, regardless of how trusted the source is. The data to show specifically in VC, where the weird and wacky things are the ones that make you the really big exits, that consensus-driven decision-making actually doesn't work. So for those of you who are thinking about setting up funds, don't have $100 million managed by 4 people. Have them each manage $25 million. The data shows that that leads to better VC returns. So I only share that because as much as we trust our network for recommendations, we always do our own diligence. And the really simple framework there is we look at the 4 Ps, right? People, problem, progress, and price. So exactly, as the gentleman said, we look for the most amazing team, domain expertise, thoughtful complementary skill set. We look for really large markets with attractive competitive landscapes in problem. From a progress perspective, I think a mistake that a lot of early investors make and founders is they'll ask the question, how much revenue do I need to have or how many customers do I need to have to be investable? And I care much more about whether or not that revenue is repeatable and what you know about your customers' needs than the fact that you have $500,000 in revenue. If you don't know things like daily active user rate, time on site, all that kind of stuff, it doesn't matter if you're just a really good salesperson, in my opinion. And then, of course, the deal terms, right? The price has to make sense from a valuation perspective.
Teresa?
I like to use the resources that are available to everybody because we're all Americans. Every time you ship something, you take it to the UPS store, you take it to the post office, you have to fill out a customs form. You have to figure out what's the SIC code, what's the NICS code. You have to say the dollar amount of the thing that you're sending, and you have to name the country. So the United States Customs Office has a huge amount of data about what's leaving our country. And there are programs you can go through to find out if you're making something here, where should it go? And then the thing that I want to do when I'm doing due diligence, I ask the entrepreneur important questions to find out how motivated they are. And I'll ask them, and also to find out if this is going to be a good fit for me. Let's see. Basically, tell me about, would you be willing to go on a trade mission? Have you thought about setting up an office overseas? Where have you looked? Where are you selling? Do you have tell me about your revenue strategy. Because if you just say, what were your revenues last year? What's the customer concentration risk? Was it somebody that you know in the region? We have to get out of our region. We have to push ourselves. We can't continue to sit on our laurels, which is what we've been doing for such a long time. So the more big data that I can use, there's a wonderful article, Airplane Pilot Protocols in Finance, which if you read it, it's very entertaining. It was in the book called The Checklist Manifesto, but it's available free online. It'll push you to really take it up a notch on your own due diligence.
Great, and Henry, maybe I'll give you one last word on this. Do you collaborate in evaluating any of the kind of deal flow that you consider investing in? You have a very specialized area of focus, and so I'd be interested to hear if you're working with collaborators on things.
We often collaborate with the others. So, we have other funds and other family offices that we work very closely with in many different regions around the world. And we also rely on some of their expertise. We touch on a lot of different industries, from supply chain to security to all sorts of stuff. And we have, PhDs from universities that we will pull in from time to time to do our due diligence with us. And, just more sets of eyes to taking a look at, things that we don't fully understand, the better decision we can make. And there's no shame in pulling experts from, outside of your firm and just to have them take a look at something that, you want to have a second eyes on.
So one other question that's come in on the sheet here is, are you familiar with any actual formal syndications where like multiple family offices that are independent are coming together on a deal and sharing resources like hiring an attorney or hiring other experts and sharing the costs of those kinds of things and then closing as a syndicate in a deal? Is that something that you've seen? What are the pros and cons? What's the process been like?
So we do that all the time. We've been doing it for years. In the Midwest, you need to work with the other angels because the dollar amounts just aren't high enough. But I think some people worry that if they syndicate a deal, that somebody might steal the deal, and that sometimes happens. Another thing that people worry about with syndication is that some people in New York came up with this treaty. You have a syndication treaty, and that's if I borrow your due diligence, I promise not to sue you if the company goes south. And I mean, that's literally the trend of years ago was let's do a due diligence sharing treaty. I still have it. It's kind of strange because everybody is responsible for their own decision making at the angel level and at the deal making level. You know, we're all accredited investors. We're all responsible for performing our own due diligence. But it's an issue when you're considering sharing your own due diligence with other groups. Who's gonna lead? Who's gonna follow?
Great. Any other input on that from the panel?
Yeah.
William?
Okay. I think just to complement that last statement, what we're doing is it's the individual lead investor which is responsible for the due diligence on that deal. It may be extensive or it may be not as extensive. A VC will spend 6+ months doing this. We have an angel group in California which spends on the biotech stuff, it's very complex. We'll do 65-page memos. That doesn't help really. It may help a little bit on the science. So what has to happen is someone has deep knowledge internally of that particular deal, and the others can come around him and share that due diligence. Yes, there's a risk, but they're all going to agree not to obviously sue one another. So I think what you're going to see is we're doing our first fund on a pledge fund basis. That one is going to be highly screened deals before they go in. Then each individual investor responds for their own due diligence, because as LPs in a pledge fund, they're investing X percentage of their pledged assets in a particular deal. But you need the crowd in here in a certain sense, because you want more people in to not just defray the additional cost of the additional rounds, but also to give comfort on, as we just talked about, on the diligence side. Or the other way you can get this is to go plug to our part. You can do it outside. You can go to an outside group to complete that due diligence if you don't have it internally. And the key point, I think, is this. The takeaway is this. You got to do some due diligence. How much you do, it depends on you. And there's no foolproof way to do a due diligence out there. It's all you can do is defray the risk. And the way to defray the risk is there's only one way to do that. That's growth to later stage deals that look more like private equity deals, but they're not at the private equity stage yet.
Great. Angela, did you want to add something? In a minute, by the way, I'm going to open it up to the audience for your questions, and so please take a moment to kind of gather your best ones. Before we do that, though, I'll ask one more question and ask you to be brief on this. But is there an area right now that's interesting to you? There's a kind of deal or a kind of investment that you're excited about, because everyone would be curious to hear just in a sentence or two from you about those kinds of opportunities and what's top of mind.
You want to go down the line?
Yeah, why don't we start at the far end?
Yeah, for us, we're looking at a lot of later stage projects now that we can take in and do a lot of enterprise partnerships and deals where we can truly drive the needle, right? And where we can add any value, there's really no point for us to be in it. We're not a passive investor at all. My background isn't passive. We're actively managing and advising companies on a weekly basis. So the places where we're highly interested is where we can uniquely drive the value and for the companies themselves.
What we do is through the new fund, what we're going to do is that provides the base investment, smaller IRR than the typical venture, because again, look more like PE deals, but that's the base where you're really not going to, hopefully, lose money, or at least not to the extent the VCs do, and target an 18 IRR in that fund. So highly screened deals going in, growth to later stage, just following your point, because I think that's the base for these type of investments. The risk-adjusted part will be in the individual investments in the earlier stage venture-type deals in this space. We're complementing that with real estate and private equity in all those areas, because you should be able to diversify your investments. The last thing is, which I think we're getting to, is what types, is there any category of investment that I would invest in today? I would take a look at the future. What looks good in the future space? Robotics, artificial intelligence, driving different businesses. To the extent you can identify those businesses in advance, and that's what you should be investing in.
One specific area that we're looking a lot in is if you think about virtual reality, if you think about the hardware of virtual reality, we're not investing in that because we think that's very difficult to predict. We're also not investing in the content layer in terms of what sits on top of it, but we're investing in the software layer that enables that content to sit on those devices. And so we're spending a lot of time looking there. And then another fun one is cannabis.
God, I already graduated from Columbia.
I went to Berkeley, come on.
Well, I mentioned earlier we're in a handful of, we call them verticals. That's senior and specialized health care. We're in suburban office. We're in data centers as the landlord, not as the operator. We're in student housing. And we are opening a new vertical this year with a group called Highgate here in the city to start investing very specifically in hospitality in the city of New York and other gateway cities. And the rationale behind that is occupancy is always very high. That's why it's so hard to get a room in the city. But what fluctuates is the price of the room. So the supply component means that's an incredibly important part of that financial equation, that economic equation. And if you look, which we do at Big Data, there are very few permits issued for the next 3 years in the city of New York to build hotels. So supply will continue, will hold constant basically, although there's an argument that it'll actually shrink because the Grand Hyatt at 42nd Street is going to lose about 700 rooms in their conversion. But there's no reason to believe that people will stop coming to the city of New York. So in very specific niche non-branded hotels, we're looking very carefully at putting $200 million of equity to work in that strategy to capture that lack of supply and the concomitant increase in revenue that has to be associated with increasing demand.
So I have two themes to talk about. One is keyword mobility. That means smartphones, smart cars, smart cities, and the whole way the world is going to change when we go toward driverless cars, when we go toward electric vehicles, driverless electric vehicles. I just was in Beijing listening to people talk about the future. I was in Seoul listening to people talk about the future. I was in Taiwan. They all said the same thing. They said mobility. They said electrification. The second thing is food. Food, precision agriculture. Precision agriculture, the rise of the global middle class means that there are many, many, many more people on Earth who want to buy good, delicious food. Sources of protein. How can we get sources of protein to the world? That's it.
Great. I'll throw my 2 cents in, and then we'll go to questions and comments from the audience. But I think, oh, sorry, did you go?
I just wanted to share one resource with the group. For those of you who want to get smart about an investment thesis or what an investment thesis looks like, just Google Bessemer investment thesis. They refresh it every couple of years. But right now they have about 10 white papers. One of them's on mobile, one of them's on consumer, one of them's on India. Just a good place to read investment theses.
Yeah, the only thing I'd add to that, and then we'll get to questions, is, sectors and specific themes are always the most exciting things to focus on and to talk about. But there are some sort of general things that are on our mind. One is there's just a tremendous premium right now for growth and stability. And I like growth and stability as much as the next person. But you can really generally buy attractive yet maybe volatile cash flows at a very, very low price today in today's world because growth and stability has been priced so dearly. And then in terms of industries, we tend to like a lot of very large industries that have not been modernized substantially. And so the application of technology or just modern methods to them can really make a big difference. And so the construction industry, the agriculture industry outside the U.S. in particular, and the restaurant industry, these are big industries. They're not nearly as exciting as a lot of the consumer and enterprise technology or the sharing economy or the personalized digital medicine. All of those are very interesting and exciting in their own respect. But some of these fairly boring industries that are modernizing with technology, the technology and solution providers there are really attractive. So with that, we're going to take questions again on syndication, mutual sharing of resources for mutual gain. Questions from the audience for our great panel. Please.
Yes, I show organizations how to be leaders, not just as individuals, but as whole groups. And of course, it means getting everybody on the same page. I used to lead people and organizations to remote and dangerous places. So if you're going to get to the top of Mount Everest in your group, you better make sure that everybody is interacting on the same terms. Can you give an example where you've found yourself collaborating with different resources at the outset, but further down the road, suddenly things went sour? How did you address that without screwing the deal up?
All right, anyone want to take that one?
I'm not sure I understood the question.
When people start collaborating and then it goes wrong, what do you do?
I
Good
think-
example of how you've dealt with that situation in real life.
Without messing the deal up?
I had a situation earlier this week where I needed to show some leadership. There was an individual who's physically much, much taller than me, who was also much, much louder than me, who was taking control of meetings that I was in. And I said to him, you know, you're really, really impressive. Your resume is impressive. Everything about you is impressive. But this is my organization, and I need to be in charge. And I can't afford you. You're so great. I can't afford you. Another way of kind of letting people know that you need to be in charge, which never fails, and it never fails, is if you say, I'm not smart enough to see how we can work together successfully and make money. I'm not smart enough. They'll never argue.
All right. Words to live by. Any other questions from the audience? We have a couple of minutes remaining. Please, right in the front.
You mentioned a little bit earlier how lead investor function work. I'm just curious, and I'm not sure how much the panel's dealt with this, but how do you perceive, or how does the role of a lead investor work for family offices versus the typical VC lead? And is it essential to investing? Do you feel comfortable investing without a lead?
The lead doesn't necessarily have to be, like we combine family offices with our high net worth investors. So it's who has the particular expertise in the space that's willing to take that lead because they're responsible for the due diligence. The family office may be, in that case, putting in more money than the high net worth investor, but we want to make sure that he will follow, because a lot of the family office don't have particular expertise in the venture space at all. So what they generally do is hire from the outside. So they're generally amenable to have someone else take the lead, but by default, they'll hire a particular outside consultant to give them the due diligence that they need.
It does depend on what you mean by lead, right? Because sometimes it just means the person who's signing the original term sheet that everyone then else has to agree on. But it doesn't always mean that the lead does the due diligence for everybody who's in the round. So the two are not synonymous always. So I think just be careful when people say lead exactly what that means.
Could I expand on that
Please.
answer? What we mean by lead is no one invests more than we do, okay? So, you know, we're 20 or 30% of the equity at all time. I don't have any clients. I have lots of partners. And it's cold comfort that if it doesn't work out, no one's lost more money than we have. But what it makes us do, and what it makes a family office believe, an institution believe, is that we're working every day to make it work as an investment, because I can't fee out my risk with their money.
Great. Question right here in the front.
Yes, my name is Antonio Ares. We're emerging fund managers, and I would like to ask this question specifically to Teresa, because you were a co-GP with a Korean sovereign wealth fund, and I'd like to ask the same question to other early venture capitalists or super angels as far as where you guys could find co-GPs for other emerging managers.
And as you think, this will probably be the last word on our panel.
Well, anybody who's a GP could be a co-GP with you if you made that deal with them. You know, if you get along with them and you say, would you like to agree with me on every single one of my deals? Or do you want to work together and we'll be joined at the hip? That's what being a co-GP is. So everybody has to unanimously agree, but you know, if anybody vetoes it, then you'll all be saved from making that mistake. But within that group, you'll get the benefit if they have something, you know, it's like proposing marriage. So find any GP that you might want to work with and then pitch them on that. But okay, with the Korean government, they have they had a specific program with the last administration there was a co-GP relationship. So the Koreans are specifically interested in getting relationships outside of the peninsula. So they were looking for foreigners who wanted to come into Korea, and with that, they put on conferences, Invest in Korea Week, and you know that's where you learn about all their programs.
Great. Well, I want to thank the panelists for sharing your wisdom and your time with us. And I think all the panelists will be outside and downstairs for the next little while. Thanks so much.
Thank you. Thank you.